Hi, everyone. Thanks so much for joining tonight. I am Kat Van Fossen. I'm a 2007 graduate of the full-time program. And tonight's webinar is for people who are interested in investing in startups and just want to know how to get started. I'm joined by a panel of 4 Booth alum who have different backgrounds, but who have all invested in either an angel or a VC fund. I'll start off by telling you a bit about myself. I became an investor in venture capital last year, and I have a very non-traditional path to investing. I don't have a background in finance, and I've been in marketing since I graduated from Booth, working in a variety of corporate roles. And I had always thought that angel or VC investing was only for tycoons on yachts who had millions of dollars to throw around and a much higher risk profile than I. But as I started to explore, I realized that you don't have to be a billionaire to invest in the venture ecosystem. And as I started to look more into it, I realized that this is not just for the ultra wealthy. It's becoming more democratized and less risky, and also really offers a great opportunity for diversification in your investment portfolio. So for those reasons, I became passionate about this asset class, and I wanted others like me, so people who maybe don't have a finance background but are curious about investing, to see the opportunity that they have. And so without further ado, I am going to introduce my 4 esteemed panelists tonight. First, we have Jackie DeMonte. She is a 2017 graduate of the Weekend program, and she's currently the VP of Hyde Venture Partners. Jackie started out as an engineer who worked for startups and then transitioned into venture capital. Next, we have Mark Shortino. I had the pleasure of being classmates with Matt in the class of 2007, and Matt has had a successful corporate career. Mark has had a successful corporate career, currently is the general manager at Vestcom. Third is Deepa Mehta. She is a 2012 graduate of the full-time program. She is the VP of Venture and Innovation at Advocate Aurora Health. She has a background in medical devices and a passion for bringing innovation to healthcare. And then last but not least is Matt Taylor, who's 2017 graduate from the executive program. Matt is currently the CEO of Wireless Information Networks. He is also starting the Laureate Venture Club, which is a U Chicago affiliated group through Alumni Venture Group, which he will certainly be talking about later. Before I turn it over to them to share their stories, because a lot of this is going to be about them and learning from their experience, there are 2 things that I want to take a moment to define first. The first is, how do we define an angel fund and a venture capital fund? So both are used to fund startup ventures. Typically, angel funds are a group of accredited investors who pool their money to invest in early stage startups. Venture capital, on the other hand, are invest in startups, but typically in later stages when the business is more than just an idea and it's generating revenue. And also, while individuals can invest in VC funds as limited partners, VC investors can also be corporations or pension funds. You can kind of think of angels as like funding infant companies, and VCs are funding toddler companies. So both are still very early stage, but one is a little earlier than the other. Also, angel investors can typically invest at a lower minimum than VC investors, but VC is becoming more accessible to individuals by some funds offering lower investment minimums. So wanted to mention that. Also, I just used the term accredited investor. In order to invest in an angel or a VC fund, you need to be an accredited investor. So what does that mean? That is somebody who meets one of 2 criteria. Either they've earned an income of more than $200,000 annually or $300,000 together with a spouse for the past 2 years, and they expect to in the future, or it's somebody who has a net worth of over $1 million, either individually or with their spouse, excluding the value of their primary residence. So accredited investors are high net worth individuals, but they're not just, the ultra wealthy. So now that we've established what these funds are, who can invest in them, what I'm going to do is I'm going to ask each of the panelists to just take a moment, tell us a bit about how they got into investing, why they thought it made sense for them. And I imagine that the audience is going to have questions as they're sharing their stories. So if you can share your questions in the Q&A tab at the very bottom of the screen, I will try and ask those questions as they come up for the panelists, but if we don't have time, we can ask them at the end. And then also the panelists can respond directly in the chat if we just run out of time. So just to start off, Jackie, I'd love if you could take the floor and just tell us a bit about you and what your experience has been in venture investing.
Great, thanks, Kat. So I have been with Hyde Park for about five years now. Joined while I was in the program at Booth, so certainly had a transition that was kind of core to my being in school and connecting with the team during my tenure at Booth. We invest in early stage tech companies across the Midwest, Southeast, and parts of Canada. So really getting in at the earliest stages, anywhere from pre-revenue companies up through about $2 or $3 million a year revenue run rate is when we get involved. And we're typically leading rounds as small as $1 million for those, early rounds that angels might come into as well, all the way up to about 6 to 8 million, which are more true and core venture funds. I got involved in venture again, primarily through Booth, but my experience in startups, I was working for a company that did IoT for critical infrastructure, was certainly a key component to me making the transition as well.
Got it. Okay. Thank you. Thanks for that. Mark, if you can tell us about your story.
Sure. So, I always had an interest and curiosity about entrepreneurship. And, having said that, I kept getting jobs at larger and larger companies, kind of the opposite of entrepreneurship, right? So I came out of undergrad and worked for a company in Cincinnati called Cintas. At that time, it was like a $3 billion company. I think it's quite a bit larger now. I came to business school to transition more into marketing. I interned at Kraft Foods, and I got a full-time job with BCG for a number of years doing consulting, and then ultimately went to Walgreens for a number of years, in a marketing role, very big company, $100 billion plus company. And then now I'm at Vestcom, which is still a pretty large company, kind of pushing $500 million. And during that time frame, I always had this entrepreneurial interest. But while I was at BCG, I got to know Guy Turner, who is one of the co-founders of Hyde Park Venture Partners. And I met him before he did that. I think he was kind of working on it because Guy was always working on something. But he was a member of Hyde Park Angels, which is this angel investment group that I'm a member of. And he said, I know you're interested in entrepreneurship. You should probably check this thing out. And I did, and I really liked it because it gave me an opportunity to, what I would say is place small bets into a portfolio of companies. And I think we'll talk more about this, but with a angel investment portfolio, you have some control over which companies you want to go into and which ones you don't. That's sort of what, I think I did that probably 7 or 8 years ago at this time now. And I've been doing it ever since. And I find it rewarding to get to work, kind of learn about the entrepreneurs. I've been a deal lead in some cases where I got to work directly with the entrepreneurial CEOs. And just sort of see the businesses grow and, kind of keep learning more about this asset class. So that's my brief story, how I got into it.
And I'm curious, how involved do you get? So as somebody who, like Jackie, she works in the fund and, that's kind of her full-time job. For you, you're an outside investor, but how involved do you get?
It's a spectrum. I mean, I don't spend a ton of time. I think it's, for the company, the companies where I'm deal lead, I spend more time, kind of working with the CEO and there to answer questions. And we'll probably talk more about HPA, but just help kind of the CEOs get to the different elements of the HPA network to help them with, a given business problem they're working on. And then for other companies, I mean, to say it maybe crudely, I sort of just follow the smart money. You know, if I see people that I know that are going into it, because we can kind of see the who's kind of doing which deals. I'll kind of learn more, decide if I want to get in, and then for those, it's pretty darn hands off. And then obviously, if I want to learn more about a company, I can. You know, so it's really sort of with HPA, you can kind of choose the level of involvement depending on the deal and your interest, and kind of if you can bring value to that company or not.
Got it. Okay, thank you. Keepa, can you tell us a bit about your background?
Sure. So my entire career has been in healthcare and in finance. So healthcare investment banking, healthcare private equity. And I think that's really where I learned before business school, kind of the stage of company that I really wanted to work with. And so when I was at Booth for the full-time program, I very much kind of focused on large organizations. So was looking at large pharma companies, and then also looking at kind of venture opportunities as kind of to see if that's something that I would want to pursue in the future. And I got really lucky, joined Amgen, which is a large pharma company based out in Los Angeles, in their corporate venture fund right out of business school. Got to do the Kauffman Fellowship, which is a 2-year venture capital fellowship in venture, and then was there for a few years, and then moved back to Chicago. Was a partner at Sandbox, which helps to manage the Blue Cross Blue Shield Venture Fund, and I've been at Advocate Aurora for a little bit over a year now, where I manage our corporate venture fund. So it's been really interesting to kind of see the spectrum of how healthcare from a stakeholder standpoint really has kind of evolved, and the types of things that they're looking at for healthcare IT and healthcare services companies. And then, similar to kind of where Mark is, I think I had a personal interest in also, making personal investments. I think from an institutional standpoint, you end up doing, I ended up doing a lot of investments in healthcare. So wanted to diversify my personal portfolio a little bit more. So I'm also a member at HPA and have looked at a number of deals. Have only been a member for a few years now. So, but it's been really interesting to kind of look outside of just healthcare and kind of see what's out there from an early stage standpoint. And obviously entrepreneurs kind of across the board are struggling with some of the same things. And so it's been a learning experience to kind of look at what food tech looks like, which I have no experience in. So that's been a learning, but been really great too.
And what made you decide to go into corporate venture as opposed to just going the VC route and focusing on healthcare?
Yeah, so in corporate venture, you actually get the ability to be both a limited partner as well as do direct investments. And so very much kind of wanted this experience of, you never know where you're going to end up in the future. And so, having a network of individuals that you have invested with from a limited partner standpoint has been really great. And just knowing what limited partners are looking for, right? So when you're raising a first-time fund, you typically don't get to be on that other side. And so it's been really interesting being an LP and doing diligence on funds, as well as kind of doing direct investments into companies as well. And then I think the other part of it is that you kind of have an edge when you're talking to entrepreneurs, because you're part of a large organization that you could have a potential commercial contract with. And so, when you're thinking about, who entrepreneurs can choose to work with, they might align towards working with a strategic partner where they can have a larger commercial contract kind of going forward too. So it helps to kind of differentiate you in the marketplace too.
Mm-hmm. Okay, great. And Matt, can you talk to us a bit about your background?
Yeah, so I am probably the least traditional person involved here. I spent my first portion of my career after undergrad was in the military. After that, went to grad school and kind of dabbled in some investment roles. But in 2015, I started a search fund, kind of concurrent with my starting the executive MBA at Booth. And so with that, I raised some operating capital from a series of LPs to look at, screen, and acquire a business to run. And through that process, which took over 2.5 years, I got to look at businesses across a wide range of industries, sizes, stages, and just all types of categories, which was fascinating, but was also very, it was educational in the sense that there's so much out there that you don't know about how different verticals are run and different stages of growth and development. And so in my current role, which was born out of the search fund, I run a late stage technology infrastructure company deploying wireless technology. But as a part of finding and running this business, I've just really realized there's so much else out there that I want to be involved with. I'd like to be participating in the growth of, and venture investing for me is a way to do that while still being able to focus on my primary specialty in telecom.
So you fast forward through a lot of your background. You were a Marine for 10 years, and then you pivoted into finance. Can you talk to us about that that decision to kind of go from military to your and was it right after that you got your master's in finance?
Yeah, so the 10 years in uniform were kind of born out of just a general interest in seeing what was going on in the world. But I hit a point where I needed to make a career transition, just kind of mentally and physically. And then, like you said, pursued a master's in finance, which led into a hedge fund and then a merchant bank. But I always kind of, I don't know, the late stage opportunities that I was dealing with in those roles were not nearly as appealing to me as kind of the impact you can have on an early stage venture or angel investment. You can still shift the strategy of the business, be fundamental in the growth aspects and the strategy of something that's really nascent. And that to me was what kind of drew me into the VC world. Spent time in massive organizations like the military, spent time in smaller growth stage companies. And for me, the latter is a much more compelling opportunity.
And can you talk about what a search fund is?
Yeah, so search fund is, and Booth has a big presence in this market. It is a way for an entrepreneur to acquire a company without actually having to start one. So you raise a portion of operating capital, several $100,000 usually, and you use that to fund the search and acquisition of a small to medium-sized business. In my case, I was targeting things between $1.5 and $4 million in EBITDA. And you have a series of LPs who fund your operating capital and then eventually participate in the acquisition of that business. And you use them to both, screen for the companies and bounce ideas off of. But it's a way for someone like me who had no experience as an operator and not a particularly deep balance sheet to go out there and find a company to run with the assistance of more established entrepreneurs.
Got it. Okay, great. A question that has come through that I wanted to pose to the group. Is it possible for alumni to pivot into the PE or VC space? And if so, how would you recommend that somebody does that? Anybody?
Yeah.
So it's actually very funny, but Jackie and I did a little panel seminar workshop this morning for current students that outlines the fact, a lot of the things around venture capital and what you could do as you're starting conversations with venture capitalists, how you should structure it. And I think part of it is, one of the key points that we made is very much that just like you look kind of around the table, there's no kind of linear path into venture. And so it's very much about how you tell your story and really relate a lot of the things that you've done from an experience standpoint into what that fund is really thinking about. And it might be a timing. It might be, they wanted somebody with your background, that sort of thing. So, I think it happens a little bit more organically sometimes versus, traditional recruiting processes that you might see in banking and consulting. But, it's very much kind of a relationship kind of building where you're just kind of really getting to know individuals and getting to know their funds really well, and then seeing how your background could really fit into it. Jackie, was there anything that I missed?
No, I think that's perfect. The one difference between folks in school versus after, I think, is the networking mindset. So all of the students that we were talking to, like half of them had emailed me before trying to grab coffee and know what we were looking for. And so the only thing I would add to what Deepa said is you have to be in the market. to let people know that you're available and interested, and that's a lot of productive conversations, not just, hey, here's who I am. It's how can I add value or show you how I can be value adding to the ecosystem or to your fund in general.
Got it. Okay, great. And Deepa, you had brought up before about your background. Is the expectation to specialize in an industry at the get-go? So if you're looking to get into VC or PE, does it help to be specialized?
So, I think it's something you have to be really passionate about, right? So for me, I've always been passionate about healthcare. I think my parents were really disappointed that I didn't become a physician. And so I think for me, it was very much about, I didn't want to do that portion of it, but, I still loved science. And so that was, it was very much taking what I was really passionate about and being able to do that from a business lens. And so I think for everybody, it's going to be different, right? So I don't think you need to be specialized. I think that you need to have, the ability to think through, complex problems, be able to really understand and how to manage people, because, ultimately ends up being kind of a very much a relationship and a people business versus, versus anything else. You're managing, your teams kind of internally within the fund, your portfolio companies, your limited partners. There's just so many people that are involved in this and making it successful. So I think that there's, I don't think the specialization is necessary. I think some people end up doing it if you're a PhD and investing in biotech, but I don't see that kind of across the board otherwise.
I think the passion point that you made, though, is a very important one. A question that just came through, Matt, if you can field this, can you elaborate a little more on the difference between doing PE investing through a search fund versus a traditional PE shop?
Yeah, so a search fund investment is typically a lot smaller and a lot more direct and less diversified, right? If you're going to park your capital with a traditional PE shop, you're going to have a pretty hefty buy-in in most cases, and you're not going to have a lot to do with that investment. I doubt very much that you're going to write BlackRock a check and then they're going to let you kind of decide where that ends up. In the search fund world, it's a lot more personal. You are going to write a small check that you need to write off as a total loss almost right away. You're going to write a check somewhere between $25,000 and $60,000 for that young aspirational searcher to go out there, and they're going to use that to pay for plane tickets and due diligence and rent and health insurance. And there is a decent chance you're never going to see any of that money again. But if it does work out, they're going to call you in somewhere between 6 months and 2 years and say, congratulations, I found a business. Now I need you to write me a $250,000 check. And you're going to take that opportunity to review the business on a case-by-case basis, look at the characteristics of the business and decide if it fits within your personal investment portfolio. Also, it's a non-diversified investment. You're picking one company and one searcher and you're going all in on that one specific investment. Whereas a traditional PE shop will allow you to spread that investment across a wide range of companies and hedge your risk slightly. So I think the possible return for a search fund investment can be quite high, but as we all know, there's a risk corollary that goes along with that.
How many businesses did you end up evaluating before you found the one?
If I count everything that I did more than just an email with the owner, it's north of 1,000. So it was a lot of companies that you look at and they don't fit the criteria, but still a very cool opportunity.
Yeah, right. Sounds like almost a full-time job. Okay. Jackie, I'd love to come back to you and ask what makes venture investing different from other asset classes? And what I mean by that is if we look at it from the standpoint of an individual investor, so not somebody who wants to go into PE, but somebody like me who said, I'm sick of investing in index mutual funds. I want something that's a little different. Why would somebody look at this as a viable asset class to invest in?
Oh, now that's a good question. So I would think about the world in you know, kind of if you start at the top, there's debt and there's equity, and obviously in our kind of public portfolios, we probably have exposure to both. Obviously, equity being a riskier but higher return asset class. And the same thing happens on the private side of things. So there are, you know, private debt markets for companies that aren't publicly traded, and then equity markets for companies that, you know, are also private. And then typically when you look at the, you know, kind of private equity market, there's PE, we talked about search funds, there's VC, and I'll kind of group angel investing into the VC class. And those tend to be opportunities that are riskier, but could provide, you know, higher returns if everything works out. Now, the difference between, you know, what Matt was doing and other PE funds are doing in venture capital is part stage, so stage of company. The companies Matt was looking at were probably, you know, more than 2 or 3 years old. Some of them might have been 20 years old,
Yeah.
maybe, yeah, 20, 30, something like that. Private equity investors obviously go up to, you know, billion and multi-billion dollar companies even that have been around forever. But at the venture stage, you're typically looking at companies that have been around, you know, months or up to a handful of years, right? So there's a different risk profile with those types of companies because, you know, they go anywhere from not having sold a single product to maybe generating a few million in revenue, but that was largely built on early adopters or folks that, you know, were risk-seeking customers versus, you know, maybe your Fortune 500s that make you jump through a bunch of hoops. So there's stage, there's the type of investment you're making. So as an angel investor or in venture capital, you're typically making minority investments, which mean you can't just come in, wipe out the management team, you know, refocus the company and set it up for growth. You're spending much more time on influencing and trying to set direction and be supportive versus, and Mark and Deepa, I'm curious, you know, with your Hyde Park Angels experience, it's probably similar. You're not, you're working with the CEO versus setting their agenda. And then I think the final thing is, you know, just expectations for outcomes. I mean, if you hit a home run in the venture business, you can get a 100x return. Of course, the large majority of investments don't don't end up in that you know, order of magnitude. But when you're in a different sort of asset class, you know, private equity, you're probably hitting doubles and triples versus home runs, and so you have to be comfortable with that risk profile of I might lose all my money, or this might be, you know, an amazing thing.
Yeah, right. Great points. I think also something to note that maybe not everyone is aware of is kind of the liquidity of this asset class, is that you are putting this money away that you're not going to be able to see for, you know, 8 to 10 years. And, you know, if you invest in stocks or bonds, you have more of an ability to get that money back and sell those off. And whereas with something like this, when you make the investment, you're in it for the long haul, baby, and gotta be comfortable with that as well. Great, thank you. Deepa, I'm curious how you think about how venture investing is shaping the future of the economy, you know, not only within healthcare, but just overall.
Yeah, and I would say that the NVCA and the Kauffman Foundation and a number of kind of organizations have kind of done studies to really show, you know, how venture-backed companies are part of the ecosystem or the economy. And, you know, there's been kind of an increase in kind of jobs, and especially tech-related jobs and other things that really are able to kind of increase kind of wealth among, you know, a number of people, kind of moving them up in terms of from an economic standpoint. So I think there's definitely a case to be made around kind of some of these venture-backed businesses and kind of what they're doing in terms of kind of wealth creation and kind of wealth management for a number of individuals. And then I think the other thing that, you know, if you look at the Fortune 500 or even the Fortune 50, in over the past 50 years, you'll see this kind of huge jump into kind of technology related businesses that, weren't even publicly traded, 50 years ago. And so they actually have kind of a massive amount of the economic kind of share right now, kind of between kind of a Google or a Facebook or an Amazon or others, that were venture-backed companies. You see a lot of those returns really coming through from an economic growth standpoint as well, and a valuation standpoint as well for a lot of those companies. So, I think just like Jackie was saying, it's a long-term play, and what we were just talking about from a liquidity standpoint. But I think that for those that are home runs, they end up being kind of huge parts of the economy and driving huge parts of the economy going forward as well.
I have a question that probably is going to come across as a loaded question, and this is one for all of you. When you're looking at making investments, and Deepa and Jackie from the standpoint of your funds, and Mark and Matt from the standpoint of just being an individual investor, how much are you thinking about the social impact of that? I want to support a minority-led business, or I want to support something that's kind of a nascent technology that hasn't had the opportunity to emerge. Talk to me a bit about how that's involved in your decision-making, or if it is at all.
I can start off. So it is part of kind of our decision criteria, and not only just from a direct investment standpoint, but from a fund standpoint as well. We look at the kind of the partner and the principal and the associate teams at all of the funds that we look at, to really try to kind of see what the pipeline really looks like, because I think that there's kind of different levels of this, right? So the Yale endowment this year, or I think just this past week, came out with their mandate to all of their teams that are managing their capital, that says that, we're going to measure you based on what your teams look like, from a diversity standpoint, from, a number of other things that they want to kind of make sure that there's that kind of diversity of thought that's sitting around the table, that's going to be kind of flowing down to entrepreneurs, ultimately. Right. So I think that, it's definitely something that, we look at. We also look at financial returns, to just make sure that for us, it's a dual, to just make sure that you're going to have a combination of both kind of going forward. So, I think that it's definitely part of the equation, and I think it will be for a long time now.
Other thoughts?
I agree, but I'll add, it has been statistically proven that more diverse teams function and perform better. And so one of the things that I personally think about a lot when we're making investments is, how is this leadership team going to be able to scale and recruit and retain highly talented team members? And that's something that you can test for pretty quickly. If you're looking at it purely from a pragmatic point of view, obviously it's just good practice to, invest with a code of ethics. And I think, we all, I'm speaking for everyone. I assume that's okay. We all aspire to, take part in that.
Great. Matt, Mark?
I'll take it in a little bit slightly different direction. Part of your question was asking if the investment thesis or guiding principles were centered around not just diversity, but around specific technologies or applications. I do a little bit take kind of what the investment is doing relative to the current market into consideration, because with venture investing, you're not trying to invest, in my opinion, in an existing platform that does an existing thing, commensurate with its competition. So when I look at telecom, I look to make investments in companies that in some cases are pre-product and pre-revenue, because what they're coming up with and what they're doing is going to fundamentally change consumer behavior, market dynamics, the way companies function, interact. And so you have to measure what that company is aspiring to do relative to the current conditions. And so just as much as you want to look at leadership team and management, you want to look at the fundamental strategy. And if I'm speaking broadly here, but if the company is just aspiring to do the next widget but slightly better, that's not a venture investment. That's an established business investment. We're really looking for something that's going to try and evolve consumer behavior or change the way we do business. So that for me is kind of a driving principle as well.
Great. Yeah. And I think you bring up a great point that kind of, would take a full other webinar to discuss, how you're evaluating the companies. But I think those are the type of things we need to be thinking about as well. Great point. Okay. Mark, anything additional there?
All the answers were very good. I mean, we're actively looking at the makeup of the teams that we invest in at Hyde Park Angels. And I think my answer is going to be very similar to Jackie's. I mean, I believe that, social good and good investment returns aren't in conflict. I think they can work together, right? So it's the things that don't pass a certain ethical boundary for me, I'm not going to invest in. And I think the other thing I maybe add to the conversation is, I think back to like when I was at Booth and Professor Kaplan, I think at the time did research around like the horse versus the jockey, with the horse being the management team and the jockey being the business. And the research said, it's all about the business, right? You can change the management team. I believe with early stage angel investments, it's the opposite. I think it's so much about the people because the business is going to change so many times before it's actually has a chance of being successful. And, so I do look at the team, from a diversity standpoint, what they're trying to get out of it. Are they really committed? Are they bringing the right skill sets? It's diversity in the sort of the broadest sense, right? Is this the right crew that kind of gets the opportunity in the market? And, they're going to show me the hockey stick graph or whatever, and that's fine. But is the plan in year one credible, right? And all those things, right? So that's kind of how I think about diversity in kind of the broadest sense, and investing in teams and people that I think meet all the standards and are trying to actually make money while making the world a little better. Because I think capitalism is actually a good thing. So.
Got it. Thank you. Great. So we've talked a lot about what venture investing is, how all of you got involved. And I've also mentioned that both angel and VC investing has gotten more democratized. And so I wanted to spend some time to talk about, well, how can people get involved? So, if we have people on this webinar who are like, okay, this is all great, like how do I get involved in that? What I wanted to do is just go through and talk about what different options are. So Matt, I'd love to start with you. You invest in Alumni Venture Group, and you're starting a Laureate Venture Club, which is a U Chicago affiliated group. Was hoping you could just talk to us about AVG, kind of what their model is, and what this venture group is, or venture club rather.
Absolutely. So Alumni Ventures Group is a fund that's been established for several years now, and they're predicated on kind of index-like returns. And in your words, I think it makes a lot of sense, democratizing VC. It is a group created to invest in venture, but designed, the vehicle's created so that the average investor is basically getting an index-like return. So the theory is that you would make an initial investment of $50 or $70 or $100,000, and that gets spread across 30 different venture investments. What we're doing with Laureate Ventures is then creating a U Chicago cohort within that organization where we can come together and discuss specific deals and review deal-specific opportunities. In the venture world, you're going to have certain investment opportunities that have excess funding requirements. So maybe there is a need for an additional $100,000 or $200,000 in a specific capital allocation. Well, in that opportunity, the people in Laureate and across Alumni Ventures would be able to review those deals on a case-by-case basis and over-allocate capital to those as they see fit. So for me, I kind of look at it as an analog to when I was looking at search fund investments and saying, what is this specific business doing? What are the characteristics? And look at that on a deal-by-deal basis. What I like about what we're doing is you get an index-like return with the vast majority of your investment, but still have the opportunity to allocate excess capital to deals that fit specific criteria for you. Be it you want to back a certain technology, or it's a certain market that you feel like you understand better than average. We have the ability to then let you participate in an outsized manner in that specific deal. And therefore you can kind of look at both active and passive management of your venture investment.
So then I would invest, you know, say 50 grand in a fund. That's going to be kind of a diversified portfolio, but then different deals come up where I could say, you know what, I want to invest 25,000 in this one particular company because I just have a lot of passion for this.
Yeah, that's precisely it. And that initial investment of yours is going to be managed by the AVG teams and spread across a variety of diversified businesses. So it's going to be a series of venture investments across industry sectors, across different stages of growth, so that you're kind of reaping the benefits of that high risk, high reward in a very UChicago type, you know, index fund basis. But then as these specific deal opportunities come through, as a group, you know, we can sit there and discuss. And if it's a telecom investment where I may have some domain knowledge, I can share that with the group and say, here are the pros and cons of this investment relative to others. If it's a CPG business where I have absolutely no knowledge, someone within Laureate may have some ability to give us some metrics upon which to measure that investment. And then everybody as an individual chooses to allocate capital to that deal or not as an individual, and then see where that goes.
So how do people get involved in this?
Yeah, there's a couple different mechanisms for getting capital into the club, all which happen through Alumni Ventures Group. Happy to make some referrals into that if you guys want to reach out after this is over, or you can just go on to the Alumni Ventures Group website and start the process there as well.
And I think that website is avgfunds.com, I think.
That is it, yeah.
Okay, yeah, great. That was one of the questions that somebody had, and if that is not answered appropriately, we'll have our email addresses at the end of this sent to people. So if you want to reach out for specific questions, you are welcome to do so. Great, thank you, Matt. Next, Mark, hoping you could tell us about Hyde Park Angels.
Sure, Kat. So, you know, HPA has been around for I think since 2007. It's raised over $1 billion since then, you know, created over 2,500 jobs, and really invests, you know, across seed stage and Series A mostly. I mean, occasionally we'll do a Series B, but, you know, and typically we're kind of coming in with a syndicated round, right? Where it might be a venture capital firm setting the price and we're kind of along for the ride. You know, we have over 100 members. There's something like 5 full-time employees at HPA. We pay membership dues, and these full-time employees are there to lead HPA and also to source and vet deals. You know, a lot of deals come through, and the quality of the deals keep getting better and better. But the way it works is, you know, as a member, you're committing to deploy, you know, at least $250,000 over 5 years. So the simple math for all you booth folks is $50,000 a year plus minus. And any given deal you can say yes or no to that kind of comes through that's been sort of sanctioned by the team members that vet the deals. And the minimum commitment for a deal is typically $10,000, right? So it allows you to make small bets across multiple deals. And, you know, and back to the booth kind of thinking, if you invest in one startup, you know, that's a little nuts. But if you invest in 30, you know, you have a pretty good chance of getting a good IRR, you know, if you're willing to live with the illiquidity of venture investing. And, you know, so that's pretty much how it works. You know, yeah, so, you know, and I think, and I saw a question on the chat around, you know, if you're an alumni and you can be a member if you're not local. I don't know the exact answer to that. And Deepa, you might know, I don't know. I know alumni it's hard because, you know, before COVID, the meetings were all in person, and for sort of confidentiality reasons, we didn't have web links into the meetings where we'd see sort of like it's kind of like a Shark Tank style like pitch, you know, where the entrepreneurs are kind of sharing their pitches with us. We've been obviously doing things virtually now with COVID. So that person that asked that, if you want to, you know, you guys are going to get our emails afterwards. I think if you want to follow up, I'm happy to look into it and see what's possible.
Yeah, there's a member application process that you end up kind of going through, and kind of there's a membership committee, and so you kind of you have nominations from other kind of members as well, as you're kind of looking to join as well. You know, I think that being involved is and being a deal lead, just like Mark said, and other things are very much things that they have expectations from members around, especially if you've got a certain expertise area. So that's part of the process.
Perfect. Yeah. And maybe just to build on that, I mean, certainly there's plenty of folks in HPA that are from the investor community that have day jobs as, traders or whatever. But they love getting folks from other, walks of life because, with just use myself as an example, coming, knowing things about marketing or how retailers make buying decisions or, whatever, it allows me to kind of be more helpful on deals where we're, looking at a company that's trying to sell stuff into retailers, right, or into CPGs or whatever. So, and I'll kind of do one more jump here. I believe actually another way to kind of get into PE and into VC is to just do it, right? So like I've done deals now, like I'm a deal lead. I've closed several deals for millions of dollars, and exits are starting to happen for a very long time. So, you get that experience and you're kind of around other folks doing deals, I think both Jackie and Deepa kind of mentioned this, like it's about that network. And if you're kind of doing things like this, you're now becoming part of that community just kind of organically by just doing it, right? With speaking with your wallet. So.
Yeah, right. How do you prioritize, this is a question that came up, how do you prioritize international deals, or is it US only? Mark and Deepa, if you can answer that from an HPA perspective, and Matt from a AVG.
HPA focuses primarily on Midwest deals. I think the original premise was that it's a bit underserved on seed stage capital. I think we're doing a little more outside the Midwest, but not much. So we're Midwest focused.
Thank you. Thanks for the clarification. Now?
Yeah, I mean, AVG does source and operate deals nationwide. I think that entrepreneurial environments are different across different markets, right? And so I think that venture capital investing happens in different phases in different markets across the world. They're not going to be the same. So AVG is primarily focused on US deals. I think that we can take non-US capital, but in terms of deploying it, it primarily happens within North America.
Got it. Great. Thank you. Jackie, I was wondering if you could answer this question of explaining the difference between series funding, like A and B, C, seed.
Yeah, I mean, they're all sort of made up series definitions, for lack of a better word. So the earlier the letter, the earlier the company. So seed are typically the earliest companies, and then comes A, B, C, D, E, F. I don't know if we've hit G, but private markets have been very strong and robust. So who knows, there might be some billion-dollar G or H rounds out there. I would say in the current market, seed defines companies that are doing maybe up to $500,000 a year in revenue run rate. Does that sound right to the other folks on the phone? Maybe. And Series A is probably that, $500,000 to $2 million in revenue, and then B is kind of after that, and then you get into more of the growth stages that largely depend on fund profiles. So that's all the the nomenclature means.
Thank you. So we've spent time talking about two very traditional models, the angel investing model of having a fund, and then the venture capital model, which AVG is a little different in kind of the way that they index things. But also I wanted to spend the last couple of minutes talking about some emerging models. So there are three that I wanted to make sure that we talked about so that people understood that there are these opportunities out there. One of them that I wanted to highlight, there's a company called 11.2 Ventures. It's a firm that's in Chicago. They call themselves a life cycle venture builder studio. Essentially what they do is they're actually building companies in-house. They're taking them from idea to revenue and then exiting the company during the development stage. And so the thing that makes them unique is that they can offer investors much higher levels of equity within particular deals. and then also a much shorter investment horizon. So they look to exit in 2 to 4 years rather than 8 to 10 years with the traditional model. So, you know, one of the big questions that people have about liquidity, this is kind of a way that you can have an option for something that is going to potentially give you your money back a little more quickly. Also wanted to talk a bit about rolling funds and then crowdfunding as well. And Jackie was hoping that you could enlighten us on what those are.
Sure. I am not an expert in either, but I can give a quick overview of what they are. So crowdfunding, which I think used to have a bad rap and is now becoming much more professionalized, similar to angel groups, allows both accredited and I believe unaccredited investors to invest in startups. They're typically tech platforms. So you would, you know, go on the platform, read the, you know, pitch deck, the due diligence that the you know, kind of crowdfunding team has put together, and then decide whether or not to commit to those deals. If the $10,000 a deal price tag kind of gave you shock, this is one of those opportunities for folks to get involved at much lower check sizes. And by the way, there are also other angel groups where I believe check sizes I've heard of have gone as low as, you know, $2,000, maybe one. If you kind of get friendly with the folks running the deals. So certainly it's much more accessible depending on which type of group you're getting involved in. The crowdfunding platforms are just ones you want to be aware of because you won't have as much access to the management team as you might if you were sitting around the table at HPA with the entrepreneurs presenting and engaging in questions. So it's certainly a different type of model, but you can get certainly the same access to that index type feature that you pick. So I call that more like angel investing. There's this very new type of fund, which would be more on the LP side. So investing in a venture fund, I would put it more in that category, called rolling funds. Now, when you invest in a traditional venture capital fund, usually there's a 3 or 4, maybe 2, 3, 4 year time horizon where that group is planning to deploy the capital over. So when you commit to, Hyde Park Fund 4, if you commit $4 million, that $4 million gets deployed over, almost, I don't know, I guess up to 10 years, right? But really you're making initial investments over a 3 to 4 year period. Of course, you don't write a check for $1 million up front. It's kind of drawn over time, but you've committed that capital and the Hyde Park team, has the ability to draw on that capital. Now a rolling fund means you commit for sort of a period of time versus a fund structure. And so let's say you commit to Hyde Park Rolling Fund October 2020. Maybe you get access to, all the deals that I do in Q4 of 2020. And then, if you commit the next quarter or the next year, you get access to those funds. The nice thing about it is you don't have this like kind of big commitment over a long period of time. And so it helps you plan your cash flows a little bit better. The downside of it is, you can miss out on that good investment by skipping a quarter or a year. And because we have such a volatile asset class, it helps to have that sort of diversification of investing assets. So those are two sort of new methods for investing in startups. Crowdfunding is certainly further along. I think it was kind of new and innovative. I don't know, maybe four or 5 years ago. I don't know if Deepa's smiling. I don't know if you remember the first like wave of crowdfunding, but rolling funds is just kicking off.
Thank you. In the 3 minutes we have left, we have 2 questions. One of them is probably going to be hard to answer in just 3 minutes, but how is COVID affecting both deals that are coming in and then the investment, the investment appetite, the size of investments? So kind of what has changed, what feels like it's kind of will stay the same?
I can speak from the HPA standpoint. I mean, we've been seeing still, I think deal flow slowed down a little bit, but we still have pretty robust deal flow. I mentioned earlier, we're doing the conversations much more virtually, of course, right? And so there's no more live pitches. The types of businesses have been changing. But there's still a lot of capital out there. I'd be curious to get the rest of the group's view on this. I really haven't seen the great deals I was maybe kind of hoping for as a silver lining of this whole thing. The price points are still maybe, a little frothy in my opinion. I think, and the other thing that's probably kind of obvious is COVID was just very kind to some businesses in our portfolio and very unkind to others, right? And it's both been impressive to see the folks that, got kind of the tailwind, how well they've been able to harness it. And then some folks that I think actually, Jackie and I are probably both involved with, that frankly have done really, really well despite having a really bad, a bad situation put in front of them and maintained, kind of held capital and found new ways to help their customers. Really, really impressive. So I think this very tough challenge is really bringing the best out of a lot of folks.
Great. Yeah. Any other thoughts on that?
I would say COVID just kind of, it affects things in the entrepreneurial space and the venture space. It's just like an amplified effect, right? I mean, the smaller the business, the more whiptail effect you have of it. So if they're going to do well during COVID, they're going to do really, really well as a venture business. If they're going to do poorly during COVID, they're going to do really, really poorly because you feel the effects of these macroeconomic conditions much more intensely as a startup stage business. You don't have the depth of customer base or the years of operating history to kind of get you better credit relationships or better, goodwill from your partners. So you can expect amplified effects of the regular economy in venture stage businesses. And so I don't think it's COVID specific. It's just the whipsaw effect of the overall economic conditions.
Great. Thank you. Want to see if we can get one final question in. A question from Drago. How do you parse out skill versus luck in venture investing? And to what degree do you get involved in day-to-day startup operations versus letting the CEO and founders do their thing? Anybody? Keepa.
I can tell you from the ABG
or
side,
Matt, yeah.
We don't get involved at all. We're a totally passive investment organization who invest alongside organizations like Lightspeed and Kleiner Perkins and Sequoia. We totally take a back seat, and one of our investment criteria is actually that there is a lead blue chip VC investor leading the round. So we will never be involved with the management team whatsoever, rather relying on leading partners to shape the outcome there with the management team.
Yeah, maybe I'll take the first part, the skill versus luck, and then maybe let others kind of opine on the second part. But I think the skill part is having a methodical process to vet things, intelligently, right? So are you assessing the opportunity, the market size, the team? But having said all that, once you have that, and the HPA is really good at that. Once you have that, it's a lot of luck. So David Rose has written a lot of books on angel investing, and for those that are interested in it, I'd encourage you guys to read them. And he started, I believe it's Gotham Ventures in New York, and I think he spoke at an HPA event, a long time ago, and mentioned how he's in over, I think, 200 venture deals. And he says all the ones he thought were going to win blew up, and all the ones he was kind of like skeptical on did great. So he's like, there's just so much. There's so much unknown. You just learn this like with small companies. I mean, things would be going great, and then a brick wall hits you, and then the reverse happens. COVID type shock to the system hits you, and then all of a sudden your company is the perfect solution, right? So there's a lot of luck, and that's why the portfolio theory that Booth has taught us all about diversification is very, very relevant in venture investing.
Got it. We ran over time. Thank you everyone for sticking around. One final question that had come through asking about the rolling funds, crowd funds. What are some of the websites? From a crowdfunding standpoint, I know there's Republic, rolling funds. Jackie, do you have a suggestion on a website to look at?
Right now, it's all through AngelList, I believe. There might be some independent managers doing it, but the platform right now is AngelList. Yeah.
Okay. Got it. Okay, good. And there are a couple of other questions that had come through. I guess maybe if we can stick around, we will answer those. But for those of you who don't want to, we know that we hit the time. Thank you so much for everybody's participation here. And certainly thank you, Jackie, Deepa, Mark, and Matt for your insight. Was very, very helpful. So appreciate it. Thanks, everybody.